According to International Business Times, Palantir Technologies stock has been on the rise again, helped by an expanded partnership with Nvidia and a fresh round of analyst upgrades just ahead of its upcoming earnings report. In this episode, we will unpack what this actually means for investors, how it ties into Palantir's long-term story, and where the risk and opportunity could lie from here. According to International Business Times, Palantir shares traded around $135.41 in midday action, up a little over 1% on the session. The move itself might sound modest, but what matters more is the context. The stock has been building momentum on the back of a narrative that is shifting from controversial government contractor toward AI enterprise platform leader, powered by both technology and Wall Street sentiment. International Business Times mentions that Palantir has now confirmed a clear date for its next key catalyst. The company will report its second quarter results after the market closes on Monday, August 3rd. For traders and longer-term holders, that date sets the stage. It defines the window for speculation, positioning, options activity, and expectations around guidance. Consensus forecasts point to extremely rapid top-line growth, with Wall Street expecting revenue to expand roughly 80% year-over-year, to around $1.8 billion. From an investor's perspective, expectations at that level are a double-edged sword. On one side, they speak to real momentum in the underlying business. On the other, they raise the hurdle the company has to clear. When a stock already trades at a very rich valuation, even slight disappointments relative to lofty expectations can trigger sharp pullbacks. So as you listen to the rest of this episode, keep that tension in mind, massive growth potential against a valuation that already assumes a lot. According to International Business Times, a core driver of the latest optimism is Palantir's expanded collaboration with Nvidia. This is not a brand new relationship but a deepening of an existing partnership. The strategy is to combine Nvidia's AI computing platform with Palantir's full software stack, including its artificial intelligence platform, its ontology layer, its Foundry platform, and its Apollo deployment tooling. For investors, the important detail here is not just that two bullworthy AI names are teaming up, but where and how they are doing it. The expanded partnership is aimed specifically at enabling government agencies to deploy AI models within classified and air-gapped environments. In plain language, that means environments that are physically or logically isolated from the public internet, with extremely tight security and compliance requirements. This type of environment is not trivial. Many general-purpose cloud AI offerings cannot be used directly in the most sensitive government contexts, because they involve shared infrastructure, more open networking, or data residency issues. Palantir has long specialized in exactly this kind of high-security, mission-critical use case. By combining Nvidia's cutting-edge accelerators and software stacks with Palantir's hardened, governance-heavy platforms, the two companies are trying to become the default AI solution set for governments that need both power and secrecy. For stockholders, the potential upside here is multi-layered. First, government AI deployments tend to come as large, long-duration contracts, often spanning multiple years with recurring revenue. Second, once Palantir's software and Nvidia's hardware are embedded into a mission workflow, the switching costs become enormous. The more the AI models are tuned, retrained, and integrated with proprietary datasets, the harder it is for a customer to rip them out and replace them with something else. International Business Times notes that this expanded government-focused solution builds on an earlier commercial launch of BrokerOS and a multi-million-dollar contract with Wheels Up, which serves as the launch customer for enterprise BrokerOS. This is important because it illustrates a pattern that investors should be watching closely. Palantir uses high-end, complex deployments to build generalized platforms, then repackages those capabilities for more standardized commercial use. Think of it as a funnel. At the top, you have unique government and defense problems that demand custom solutions. Out of those engagements, Palantir hardens its core tools like Foundry, AIP, and Apollo. Then, it wraps them into productized offerings like BrokerOS or SurfOS, which can be sold at scale to commercial customers in sectors like aviation, logistics, and financial services. According to International Business Times News, Palantir has also expanded its partnership with Surf Air Mobility. The company is committing more engineering and go-to-market resources to accelerate the development and commercial rollout of SurfOS, including offerings like OperatorOS, OwnerOS, and SurfOS Enterprise Solutions. From an investment view, this is another example of Palantir positioning itself as the operating layer for complex, asset-heavy businesses. Aviation, especially regional and next-generation air mobility, is data-intensive and highly regulated. There are fleets, maintenance schedules, dynamic pricing, fuel management, route optimization, and customer experience factors. A platform that can digest all of that data and surface AI-driven decisions can create real, tangible value. If Palantir and Surf Air can show that SurfOS materially improves margins, utilization, or safety, that becomes a compelling case study for other operators. International Business Times further mentions that Palantir has announced a strategic partnership with SNP SE at the Transformation World event, and a new operating model framework with Rackspace technology focused on AI deployment in production environments. These developments might sound more technical, but they matter strategically. SNP operates in the data transformation and ERP migration space, while Rackspace has deep roots in managed cloud services. Joining forces with players like SNP and Rackspace helps Palantir plug into existing enterprise IT ecosystems. It reduces friction for corporate customers that want to deploy Palantir's AI tools without reinventing their entire infrastructure. When investors hear words like operating model framework for AI in production, think in terms of standardization and repeatability. The more Palantir can turn complex AI rollouts into repeatable patterns, the easier and cheaper it becomes to win and implement the next customer. According to International Business Times, Wall Street analysts have been increasingly supportive. The stock now carries a consensus buy rating, with an average price target around $187 and change. Several firms have either initiated coverage or raised their targets recently. Pat Davidson shifted to a buy stance and boosted its target. Rosenblatt has kept a buy with an even more aggressive price objective. Wolfe Research has moved the stock up to a peer perform rating from a more cautious view. For investors, analyst upgrades are useful not because they are always right, but because they shape flows of capital and sentiment. When more firms move from neutral to buy, it can unlock allocations from large institutions that follow rating guidelines. It also often triggers inclusion in more bullish research packages shared with high net worth and institutional clients. International Business Times points out that some analysts are focusing on Palantir's track record of converting pilot programs into multi-year, high-value contracts. This is a critical point. Many AI and software companies boast long lists of pilots, proofs of concept, and experimental deployments. But those small projects do not always turn into meaningful recurring revenue. What Palantir appears to be doing well is turning those early pilots into deep, long-term relationships. Once a customer starts using Palantir's platforms to run core operations, it becomes nearly irresistible to expand usage, add more use cases, and lock in across the enterprise. That creates what analysts describe as a feedback loop. Successful pilots lead to larger contracts, which show up in the numbers, which then justify higher price targets and valuations. Those higher valuations, in turn, attract more momentum-oriented capital, which supports the stock price and makes it easier for the company to invest aggressively in growth. According to International Business Times News, there is a broader narrative shift underway. Palantir, long pigeonholed as a government and defense contractor, is showing accelerating adoption of its artificial intelligence platform among Fortune 500 companies. Analysts increasingly describe this as a pivot from a government-centric profile toward a more diversified enterprise software story. For shareholders, this narrative shift matters almost as much as the raw numbers. Pure government contractors tend to trade at lower multiples because their growth is seen as more modest, and their revenue is heavily tied to public budgets and political cycles. High-growth enterprise software and AI firms, on the other hand, often command premium price-to-sales and price-to-earnings multiples, especially if they demonstrate usage expansion within large corporations. If Palantir can credibly show that it is winning across airlines, logistics operators, manufacturers, financial institutions, and healthcare providers, the market may be willing to sustain a very elevated valuation for longer. Investors should watch for metrics like commercial revenue growth, number of commercial customers, average revenue per customer, and net dollar retention in the commercial segment. These are the types of signals that can convince skeptics that Palantir is not just a government specialist with a thin commercial veneer, but a genuine enterprise AI platform. International Business Times also acknowledges that Palantir's valuation remains a key point of contention. The stock is trading at a price-to-earnings multiple north of 140 times, and a price-to-sales multiple on the order of dozens of times sales. For comparison, many mature software companies might trade in the single-digit to low double-digit range for price-to-sales, and far lower on earnings for businesses with similar growth. From an investor's standpoint, such a steep valuation embeds an assumption that Palantir will sustain very high growth for a long period, maintain strong margins, and avoid major disruption from competition. Bulls argue that the company's unique positioning in secure, mission-critical AI and data integration justifies that premium. Bears warn that even small stumbles in growth, or a shift in sentiment toward more value-oriented investing, could compress those multiples sharply. One way to think about this is in terms of margin of safety. When you buy a stock at a relatively low multiple, you leave more room for error. When you pay a very high multiple, you need a lot to go right. Palantir is clearly in that second category. Investors comfortable owning it often see it as a long-duration, high-conviction bet on AI infrastructure and data-driven decision-making for governments and large enterprises. According to International Business Times, CEO Alex Karp has also been very vocal about the broader social and economic implications of AI. In a recent appearance on Matthias Dopfner's MD Meets podcast, he warned that AI could become one of the largest drivers of wealth inequality in the United States. He called this dynamic the biggest problem in the country and framed AI as a force that could fundamentally reshape the economy. For investors, this commentary is important for several reasons. First, it shows that Karp is acutely aware of the broader regulatory and social context in which Palantir operates. If AI is perceived as deepening inequality and displacing workers without adequate retraining or redistribution, political and regulatory pressure will rise. Companies that have proactively engaged with these concerns may be better positioned than those that ignore them. Second, Karp's perspective reinforces the idea that Palantir aims to be at the center of this transformation, not on the sidelines. The company's tools are designed to help institutions, both public and private, wield data and AI more effectively. That positioning could make Palantir both a beneficiary of AI's growth and a lightning rod for debate about how that growth is distributed. According to International Business Times news, Palantir's stock has continued to trade with considerable volatility even as the broader trajectory this year has been upward. Shares rose more than 2% on the day the company simply announced the date of its earnings report. That kind of reaction underscores just how headline-sensitive the stock has become. The article also cites a roughly 9% single-day surge on July 1st, triggered by the announcement of the strategic partnership with Nvidia and a disclosure that President Donald Trump holds a significant personal stake in the company. Whether one sees that political linkage as positive, negative, or neutral, it clearly contributed to the day's trading frenzy. For active traders, this volatility can be an opportunity. For longer-term investors, it can be a source of stress. When you see a stock reacting sharply to incremental news, it is usually an indication of a crowded trade. Many investors are watching the same headlines, sentiment can swing quickly, and options activity can amplify moves. Palantir's relatively wide 52-week trading range, from a low in the low hundreds to a high above 200, reflects that push and pull dynamic. Bulls focus on surging revenue, expanding partnerships, and a strengthening commercial footprint. Bears focus on valuation risk, competitive threats from hyperscale cloud providers, and political controversy. According to International Business Times, one of the most closely watched metrics in the upcoming quarter will be free cash flow. In a world where many growth stocks run large operating losses, Palantir's ability, or inability, to generate strong and sustainable free cash flow will be a crucial test of whether its premium valuation is supported by underlying economics. Free cash flow matters because it represents the cash left over after a business pays for its operating expenses and necessary capital expenditures. It is the money that can be used to reinvest in growth, pay down debt, buy back shares, or potentially return capital to shareholders over time. For a high multiple stock, strong free cash flow can provide a kind of safety net. It says, even if growth slows a bit, the company is already generating real cash that can support the share price and strategic flexibility. Several analysts quoted in the coverage argue that solid free cash flow trends would reinforce the bullish case. That would show that Palantir's growth is not just top-line vanity, but accompanied by improving profitability and operational leverage. On the other hand, any sign of decelerating free cash flow, or a reversal toward negative cash generation, could reignite concerns that investors are overpaying for growth that is still unproven at the bottom line. So as we approach the August earnings report, investors will not just be watching revenue growth and headline partnerships. They will be scanning for signals about margin trends, stock-based compensation, capital intensity, and the balance between aggressive expansion and disciplined financial management. What does all of this add up to for investors and enthusiasts following Palantir today? First, Palantir is increasingly positioning itself as a foundational AI and data operating system for both governments and large enterprises. The expanded Nvidia partnership, the SurfOS expansion, the SNP and Rackspace collaborations, and the growing adoption of AIP among Fortune 500 firms all point in that direction. If this strategy works, the company could become deeply embedded in critical workflows that are very hard to dislodge. Second, the market is already pricing in a lot of that potential. With valuation multiples stretched by conventional standards, Palantir does not leave much room for major execution missteps. Earnings reports, contract wins and losses, competitive developments, and regulatory risks all have the power to move the stock sharply. Third, free cash flow and commercial diversification are the two levers to watch most closely. Sustained, strong free cash flow would show that Palantir's model is not just about headline growth, but also about durable economics. A steadily rising share of revenue from diversified commercial customers would support the argument that Palantir deserves to trade closer to premier enterprise software names rather than traditional government contractors. Finally, investors should remember the backdrop. Palantir operates at the intersection of cutting-edge AI, national security, big government budgets, and social debates about privacy and inequality. That is a powerful but volatile mix. For some, this makes the stock an exciting high beta bet on the AI infrastructure theme. For others, it makes Palantir too politically exposed and richly priced. As always, anyone considering exposure to Palantir should align the position size and time horizon with their own risk tolerance, investment goals, and view on the long-term adoption of AI across mission-critical environments. Thanks for listening to this episode. If you found this analysis helpful, consider subscribing and sharing the podcast so you do not miss future deep dives into the companies shaping the AI and data revolution.